U.S. President Donald Trump has updated tariff rates for a swath of countries, ramping up trade barriers with some of America's closest trading allies. Canada has been slapped with a 35% levy. Switzerland, as I mentioned, Switzerland's rate is now 39%, while Taiwan faces a 20% duty.
The United States has slapped one of its highest tariff rates on the Alpine country. Switzerland now has to contend with a flat 39% charge on its exports to the U.S.
Gold has always been a safe haven, a lifeline in times of crisis. But now, Washington has turned that lifeline into a weapon. On August 12, 2025, the Trump administration slapped a 39% tariff on Swiss 1 kilogram gold bars, targeting the very heart of the world's refining hub. Overnight, markets froze. 18 metric tons of gold worth $1.2 billion were stuck in limbo. Spot prices in New York exploded to $3,548 per ounce, creating a $37 gap with London. This wasn't just about metal. It was about power, leverage, and survival. Jewelry makers panicked, electronics firms braced for shortages, and investors scrambled as volatility hit levels not seen since 2008. In Canada, watching closely, knowing if gold could be weaponized, aluminum, nickel, and even auto parts could be next. This story is only beginning. Hit like, subscribe, and keep watching. You won't believe what happens next. The moment that 39% tariff hit, the gold market convulsed. What looked like a policy paper on Trump's desk instantly translated into chaos in vaults, refineries, and trading floors worldwide. Switzerland, the world's refining hub that processes 2/3 of global gold, suddenly became ground zero in a trade war. Cargo jets carrying bullion were frozen mid-route, with 18 metric tons, $1.2 billion worth, stranded at customs checkpoints. Banks, jewelers, and manufacturers who rely on those shipments found themselves staring into an abyss. Prices didn't just rise, they detonated. In New York, spot gold surged to $3,548 an ounce, the highest in history. Traders described the rush like a financial earthquake, ripping through balance sheets. Meanwhile, London's market lagged behind, leaving a bizarre $37 arbitrage gap between two of the world's biggest trading hubs. That gap alone represented billions in sudden opportunity for speculators and billions in unexpected costs for industries that needed stability. For American jewelers, the fallout was immediate. The industry, already battling thin margins, saw costs spike by 11% almost overnight. Retailers warned that wedding rings, bracelets, and watches could see price tags climb before the fall shopping season. In electronics, where gold is quietly essential for circuit boards and connectors, procurement managers scrambled. Goldman Sachs projected that if U.S. inventories ran dry in 6 to 8 weeks, electronics could face an 8 to 10% jump in costs. That doesn't just hit tech giants. It filters down to smartphones, laptops, and even medical devices. And the pain didn't stop there. Wall Street, sensing blood, went into frenzy. Hedge funds piled into gold futures, amplifying volatility, while pension funds scrambled to rebalance portfolios that were suddenly misaligned. It looked less like a tariff policy and more like a currency war disguised as trade enforcement. The Federal Reserve faced pressure as inflation jitters reappeared, not from oil, but from gold, a commodity that isn't even a daily consumer good. But for Switzerland, the calculation was simple. If the U.S. slammed the door, new doors had to be opened. Refineries in Zurich and Geneva began rerouting shipments toward Dubai and Singapore, two rising global hubs for bullion trade. Within days, cargo manifests shifted, and what should have landed in New York vaults was instead being unloaded in the Gulf. To many in the financial world, it was a clear sign that America was losing grip over a commodity it once dominated through trust, not tariffs. Canada, meanwhile, was watching like a hawk. The gold tariff wasn't about Canada directly, but the precedent was terrifying. If Washington could weaponize gold, what stopped it from turning on aluminum from Quebec, nickel from Sudbury, or auto parts from Ontario? Canadian executives huddled with government officials, running scenarios. Could Ottawa handle a 30% tariff on aluminum? Could Sudbury's copper mine survive if exports were suddenly cut off? Mark Carney, Canada's finance minister turned trade strategist, framed it bluntly. This isn't about gold. It's about volatility. If the US can disrupt a $12 trillion market overnight, then no sector is safe. His words echoed in boardrooms across Toronto and Calgary. Diversification wasn't optional anymore. It was survival. And so Canadian companies began quietly exploring new partners. Deeper ties with Mexico, stronger contracts with Asia, and even backup supply chains routed through Europe. For US consumers, the reality was beginning to sting. Jewelry wasn't just more expensive, it was becoming harder to find. Electronics giants signaled potential delays in fall product launches, blaming uncertainty in component sourcing. And automakers, who use gold in specialized wiring, added their voice to the growing chorus of frustration. By mid-September, analysts warned that these costs would filter down to households as inflation hit ordinary products. Phones, laptops, even sneakers laced with electronics that rely on gold-based circuits. The irony? The US had set out to punish Switzerland, but it was America's own industries and consumers who were bleeding first. Farmers in the Midwest, already hit by August 1st tariffs on Canadian goods, now faced higher input costs as machinery parts became more expensive. Manufacturing hubs in Ohio and Michigan saw layoffs looming. The White House called it short-term turbulence. Wall Street called it something else entirely, a self-inflicted wound. And this was only the opening act, because gold wasn't the only target. Behind the curtain, the administration was preparing its next move, a tariff program on pharmaceuticals set to roll out in phases. That meant not just higher costs for wedding rings and smartphones, but potentially for life-saving medicines. But before the storm of pharmaceuticals hit, the gold chaos was already reshaping alliances, rerouting billions in trade flows, and forcing Canada to rethink its entire strategy. The message was clear. In this trade war, no commodity was safe, no partner was guaranteed, and no consumer would escape untouched. And what happened next would shock everyone. If gold was the spark, pharmaceuticals became the wildfire. Barely weeks after markets reeled from bullion tariffs, Washington unveiled its next act, a phased tariff program on medicines. It started modestly at 15%, but the blueprint revealed something far darker, a climb toward 150% to 250% by 2027. Suddenly, America wasn't just weaponizing luxury metals, it was weaponizing health. The numbers were chilling. The European Union, responsible for 20% of branded medicines sold in the US, braced for impact. India, the world's generic drug powerhouse, faced the same. And behind them stood China, supplying nearly 60% of global pharmaceutical ingredients. Together, they formed the backbone of the world's medical supply chain. By declaring tariffs on this sector, the US didn't just shake markets. It shook the foundation of global health. Hospitals, insurers, and pharmacies were the first to sound the alarm. Branded drugs from Europe were already expensive. With tariffs, copays in the US threatened to rise by hundreds of dollars per prescription. For life-saving treatments like insulin, cancer therapies, and heart medications, the added costs could price out millions of Americans. Analysts at Brookings estimated 32,000 to 41,000 job losses across U.S. manufacturing and distribution, as domestic firms faced cost surges they couldn't absorb. In Canada, Ottawa knew it couldn't stay untouched. The U.S. rolled out a most favored nation pricing rule, designed to prevent Americans from paying more for drugs than their northern neighbors. In practice, it threatened to drag Canadian prices upward, blowing a $1.3 billion hole in Ontario's drug budget alone. Canadian patients, long shielded by cheaper prices and bulk procurement, suddenly faced shortages and higher bills. Ottawa's health ministry quietly warned provincial governments to prepare for stockpiling measures. Meanwhile, Indian exporters sounded the alarm. Tariffs on generics meant global shortages, not just U.S. shortages. The math was brutal. If 60% of global active pharmaceutical ingredients came from India and China, any disruption cascaded worldwide. Europe feared supply bottlenecks. Africa, heavily reliant on generic imports, faced an existential health risk. What began as an American trade tactic threatened to spark a global medication crisis. And as if medicine weren't enough, the ripple effects bled into everyday consumer life. Walmart, already hiking prices after August's tariffs on consumer goods, warned that pharmaceuticals were just the start. Shampoo, toothpaste, sneakers, and even packaged foods, many dependent on chemical inputs, would creep higher in price. For households, it wasn't one bill that grew heavier. It was every receipt. Families in Ohio, Michigan, and Pennsylvania saw grocery and pharmacy costs climb at the same time as wages stagnated. The political fallout was immediate. Governors in Midwestern states, many of them Trump's allies, began fielding calls from furious voters. "Why is my heart medicine suddenly 40% more expensive?" became a campaign slogan for Democrats eager to exploit the chaos. Wall Street analysts flagged tariff fatigue, warning that investor confidence was cracking under the strain of constant policy whiplash. Globally, the U.S. looked increasingly isolated. The EU, furious over pharmaceutical targeting, questioned Washington's commitment to free markets. Switzerland, already rerouting gold, openly explored creating an alternative trading bloc with Singapore and Dubai. India, once a quiet ally, openly hinted at closer ties with Beijing to shield its drug industry. Washington's trade war was no longer a U.S. Canada issue or a U.S. Switzerland issue. It was morphing into a U.S. versus everyone showdown. Canada, however, chose a different path. While many expected Ottawa to retaliate tit for tat, Mark Carney's team doubled down on strategy, not spectacle. Instead of tariffs, Canada deepened integration with Mexico, building a North American alternative that didn't depend on Washington's volatility. Mexico's ports became backdoor lifelines for Canadian goods, while Canadian pharmaceutical importers opened negotiations directly with Indian suppliers, bypassing U.S. distribution chains altogether. This quiet repositioning reflected a new Canadian doctrine: don't fight the tariff storm head-on. Outlast it. The idea was simple. While Trump escalated chaos, Canada would secure resilience. And in doing so, Ottawa began to look less like Washington's junior partner and more like a steady hand for global investors fleeing U.S. unpredictability. But the costs inside America were mounting. By late fall, Goldman Sachs revised its inflation forecasts upward, citing the dual shock of gold and pharmaceuticals. Manufacturing towns saw layoffs accelerate. Retail giants slashed orders. And whispers in Washington hinted at the unthinkable: tariffs expanding to agriculture. Corn, soybeans, beef, and wheat were suddenly on the rumor list. If that hammer dropped, food prices wouldn't just inch higher. They would skyrocket. It was a vision few wanted to confront. Americans paying more for medicine, more for food, more for consumer goods, all while allies distanced themselves. Canada diversifying trade. Europe losing trust. Asia building new hubs. The so-called tariff war looked less like strength and more like a spiral. The final question hung heavy. Was this really about leverage, or had tariffs become an addiction, a blunt instrument wielded without concern for fallout? And if medicine could be targeted, if food could be next, then the trade war was no longer about geopolitics. It was about survival, economic and human. The gold tariff was supposed to show strength. Instead, it exposed fragility. It froze $1.2 billion in shipments, sent prices to record highs, and forced Canada, Switzerland, and others to redraw their trade maps. Then came the pharmaceutical shock, a policy that risks turning a supply chain crisis into a health crisis, leaving ordinary families paying the price while global trust in America erodes. Canada, under Carney's watch, is adapting, not retaliating, building alliances with Mexico and Asia while Americans face higher costs on everything from wedding rings to insulin. And the scariest part? This isn't finished. Agriculture looms. Food security could be next. So ask yourself, how far will this trade war go? And who will really pay for it? If you found this breakdown valuable, hit like, subscribe for more urgent analysis, and stay tuned. The next chapter is already being written.